Hello investors, welcome back to the Trend Trader channel. By the end of this video, you will know a couple of things with regards to dividend investing. We know that we are all in the market to make money. It doesn't matter whether we call ourselves traders or investors. At the end of the day, we are there to make money. And in order for us to be able to make money, it means that we need to ensure that there are some things that we are aware of before we start investing. And before we start with the video, I would like to ask those who haven't subscribed to please consider subscribing. And if you find value in this video, please smash the like button. Feel free to share this video, and we always appreciate your comments in the comment section. So today we are going to be talking mostly about investing and dividend investing, and some of the things that you need to take into consideration when you want to become a dividend investor. The first thing that we want to talk about is the dividend yield. The dividend yield, it's just a simple calculation. We take the dividend that has been paid over the past 12 months, and then we divide it by the current share price. Now, this is where the catch is at. Because we divide it with the current share price, it means that the dividend yield at any time, it is changing. It is not a fixed value. The only thing that is fixed in the dividend yield calculation is the dividend that has been paid in the last 12 months. So depending on where you are investing, you can get different frequencies of receiving a dividend. In South Africa, most of the companies, they pay dividends 2 times per year. There's interim dividend and there is final dividend. So that gives you 2 dividend payments in 1 year or in a period of 12 months. But in the US, it is common that the US companies will pay you dividends every quarter. Even in South Africa, we have British American Tobacco, which pays a quarterly dividends. In this context, we are talking about the stocks. We are not talking about ETFs, as we know that there are ETFs that pays bi-monthly dividends like the Satrix capped all share ETF, and also most of the other ETFs, they also pay a quarterly distributions. They don't call them dividends, they call them distributions. And then also we have some ETFs that pays twice per year or semi-annually, and some that pays distributions once per year. So now going back to the equation of a dividend yield, what you need to do as an investor. So whenever you choose a company, you shouldn't just choose a company based on its dividend yield. Remember, a higher dividend yield or it implies that that company pays a higher dividend. So if you use a fixed share price of 100 rand per share, then a company pays a dividend of 10 rand per share. That is an easy 10% dividend yield. So if you look at a company that pays 5 rand dividend per share, that is a 5% dividend yield. So when you compare those two companies, it is easy to want to invest in a company that pays a 10% dividend yield, or that pays 10 rand per dividend per share. It is logical. It is something that makes sense. But it is more than that when you compare companies that are operating in different sectors or in different industries, because a certain industry might have a sort of an average dividend yield that is different from another industry. So whenever you compare companies, don't just compare them based on dividend yield alone. I mentioned that the dividend yield is always going to change as the share price is changing. So from the equation of the dividend yield, we know that the dividend yield has a direct relationship with the dividend that is paid, but that dividend is only fixed for the previous 12 months. Now, when you look at the share price, because every day or every business day, there are people that are buying and selling shares in the particular company. So the share price is going to fluctuate. It can go down, it can go up. So now the dividend yield has an inverse correlation with the share price. What it means that because the dividend that is paid is fixed. So going back to the example of a company that pays a 10 rand dividend per share, that dividend is going to be fixed for the previous 12 months. So today we look at the share price of that company. We see that the share price is 100 rand per share. So today we get a dividend yield of 10%. Tomorrow, if the share price of that company grows by 20%, now the share price is 120 rand per share, then the dividend yield of this company is going to decrease. I think it is going to go to about 8%. I'm not going to do the exact calculation, but because the share price is going up, the dividend yield is going to go down. So now that might seem like it is a bad thing, but look, the share price of that company that you bought at 100 rand is now trading at 120 rand per share. So you have 20% capital gain on that company, even though the dividend yield has decreased. The company can still maintain and pay you a dividend of 10 rand per share. So now you have 20 rand potential gain that you made through capital gain plus the dividend, but that is dividend before tax, obviously. So you can see that it is not necessarily a bad thing when the dividend yield of a company goes down, as long as the share price of that particular company goes up, because you still make money from capital gain. Now the problem starts when the share price of a company starts to drop. So you buy the company at 100 rand per share. Tomorrow, the share price of the company is 8 rand per share. The dividend is still fixed at 10 rand. Now, when you do the numbers, you will see that the dividend yield of that company now is greater than 10%. So the investor that bought the company today at 100 rand per share, they might be excited that they bought the company at a 10% dividend yield. But the investor that is going to buy the company tomorrow is going to feel even better, because now the dividend yield has went up, even though the value of the dividend itself, it hasn't changed, right? So now that is something that you need to think about whenever you filter companies using dividend yield. Don't just be quick to look for companies that have a higher dividend yield. That is not to say that a higher dividend yield it is a bad thing. It is a good thing, but you also need to look at other factors such as the share price, where that particular company is operating. By that I mean the industry, in which industry that business is operating, because some businesses are operating in cyclical industries. You look at commodity miners, sometimes they're in a bull market, sometimes they're in a bear market. So all these companies that are growing in terms of share price, their dividend yield can potentially be reduced during the prices, when the prices go up. I know that sometimes the commodity miners, they make a lot of profit and then they start to pay fat dividends. So whenever a company pays a large dividend, that can help to sort of maintain the dividend yield. But if the dividend yield is not growing as fast as the share price, because remember, it is possible for share price to grow by over 100%, even in a period of 1 year. It happens. But what are the chances that the dividend yield can just grow from 10% to 20% in 1 year? That means that the company will have to double the dividend that they are paying. And also another thing that you need to keep in mind is that sometimes companies, they pay special dividends. So now when you look in the period of 12 months, you see that there's an ordinary dividend that was paid, and also there was a special dividend that was paid, and that is going to affect the dividend yield. So you need to think about that and see how much dividend that the company is paying, right? So now we don't want to make everything seem so negative about the dividend yield, but that is something that you need to pay attention to. Then again, another thing that you need to be mindful of is inflation. It is important, or it would be useful or worthwhile for you to know where the country's inflation is at, because if the country's inflation is at around 7%, then you will be better off investing in companies that have a dividend yield that is greater than the inflation, because that will help you to keep the purchasing power of your invested capital. Again, it depends where you are. If you're investing in South Africa, it is possible to find companies that have a dividend yield that is greater than 5%. But if you're investing in the US, it is rare to find companies that have dividend yield that is greater than 5%. Even finding a company that has a dividend yield that is greater than 3% in the US, it is a difficult task. But look at the interest rate in South Africa and compare them to the interest rate in the US, at least before 2022, when the US started to increase the interest rate. There was a time where in the US the interest rate were so low, they were below 1%, and in South Africa we were already up there with somewhere around 5% interest rate. So you need to pay attention to the inflation rate and the dividend yield, that okay, how much money you are going to get from that company whenever the company pays dividend. And then another thing to keep in mind is that all these companies, they pay dividend per share. So sometimes whenever anybody shares information about a company dividend, there's always going to be those questions that, okay, how much money am I going to get from the company since they are going to pay this X amount of dividend? The dividend is paid per share. So if you have one share and the company is paying a dividend of 1 rand, it means that you're going to get 1 rand before tax. In South Africa, there's 20% dividend withholding tax. So it means that whenever a company pays you 1 rand, SARS is going to pocket 20 cents and you're going to receive 80 cents per share. So now the more shares you have, the more dividend that you can potentially get. So if, for example, you want to have a target, how much money you want to receive from a specific company, you can look at the dividend that the company has paid. If the company has paid a dividend of 1 rand historically, and it pays that 1 rand every 6 months, so it means that per year you potentially going to get 2 rand per share. Then after tax, we are going to get 1 rand 60 per share. Then you can calculate if you want to receive 1,000 rand from that particular company. You can take 1,000 rand and divide it by 1 rand 60 cent. Then you see how many shares you should buy in that particular company. The amount that you're going to invest in that company is always going to be far greater than the amount that you're going to receive from the dividends, because the dividends, they are just a small percentage compared to the share price. Again, it is something that you need to think about. Investing at sometimes does require a lot of money, but if you don't have a lot of money, you shouldn't be discouraged either, because it is always better to start than not to start and say that you are waiting for a time where you are going to have a lot of money. So in a nutshell, things that you should pay attention to is the dividend yield, how the dividend yield changes as a function of share price. You need to be mindful of the inflation rate. It is better to try and invest in companies that can pay or that have dividend yields that are greater than the dividend, than the inflation. You need to understand how much shares or how many shares you need to buy in a company in order to receive a certain dividend, because all these companies, they pay a dividend per share. Then now, since we are aware that the more shares we have, the more dividends that you can potentially receive from a company, then whenever you're choosing companies, it shouldn't just be about the quantity of shares that you can buy in a particular company. It should also be about the quality of the business. Because at the end of the day, if the business is not profitable, you are not going to make money. It doesn't matter how many shares you have in that particular business. You're just not going to make money, because the business itself, it needs to make enough money to pay all its bills. Then once there's profit that is remaining, then the management can write to the board to request that a portion of the profit is passed on to the investors. So if the business is not making money, you're not going to get any dividends from that company. It doesn't matter whether you have 1 shares or you have 100,000 shares. So it is important to also think about the quality of the business, where the company is doing business, how solid that kind of environment where that business is operating, the kind of market share, the profitability, all those kinds of things that drives the revenue that the business is generating. Because remember, the revenue is the total amount that comes in. Then there are a lot of expenses in there, including tax. Then after, we have after tax profit. Then the dividend is paid from the after tax profit. So if you just, for example, invest in a penny stock because it is selling cheap in terms of a rand price, then the a penny stock might not be a good company that can potentially pay you a dividend. Whereas if you invest in a company that is known for paying dividends for a number of years, a company like Coca-Cola or ShopRite, yes, the share price of those companies, Coca-Cola, ShopRite, it is also going to fluctuate from time to time. The dividend yield is also going to fluctuate from time to time. But historically, those companies have been paying dividends for a long number of years. Even though those companies have paid dividends for so many years, there's nothing that can stop those companies from failing to pay dividend. So investing is not like a foolproof kind of thing. There's still going to be some things that can happen in those companies. Maybe foolproof is not the correct word, but it is not necessarily that it is not guaranteed that if you buy shares in a company that have been paying dividends for the previous number of years, does not mean that the company can just stop paying dividends. When there was the emergence of COVID-19, we saw some companies, they stopped paying dividends because nobody knew how long COVID was going to last. So some of those companies, they wanted to preserve the amount of money that they have so that they can sort of ensure business continuity despite the pandemic. But fortunately for Shoprite, Shoprite didn't stop paying dividend. Redefine properties, because I had a position on redefine properties. I know redefine, they didn't pay a dividend at least in one reporting period. Then in the following period, they did pay a dividend. But Shoprite didn't stop paying a dividend. Then you look at a company like Sasol. At some point, Sasol was growing up nicely in terms of share price. They were paying dividends. Then there was the Lake Charles issue. There were some other things. The oil price did collapse a bit. Then at some point, Sasol didn't pay dividend. Now, I'm not saying that Sasol is a solid company, but Sasol is a big corporate with a big market share. They've paid dividends, but there was a period where they didn't pay dividends. At this moment, Sasol has resumed paying dividend. The recent dividend amount that they have paid was 7 rand per share. So just by buying good quality companies does not necessarily guarantee that you will always receive a dividends. There will be some rainy days, and I guess then it comes the issue of diversification, because not all companies are going to be affected equally. Well, we saw with COVID, majority of the companies, they seem to have been affected. But like I said, Shoprite was able to continue to pay dividends. So when you diversify, you buy a couple of companies, not just one company. Some of the companies might not perform well, some of the companies might perform well, some of these companies might stop paying dividends, while some of these companies might increase the dividend amount that they are paying to investors. So that's it for today. I think I've already said a mouthful. Again, if you haven't subscribed, please consider subscribing. If you found value in this video, please make sure that you smash that like button, and please share this video. And if you have any comments or suggestions, please leave them in the comment section. I will see you in the next video.